Hi, Jeff. So we're here to talk about to go private, or public even, or not to go public.
Right.
And you're one of the best people in the world to possibly talk about this. You took OpenTable public as a chief executive with Andreessen. You sit on the board of Airbnb and Pinterest and these companies that are raising tons of money and staying private. So what's your basic advice here? What are the factors that an entrepreneur needs to take into account on making that big jump?
Basically, the meme right now is going public is evil, and no one should ever do it. And we think that meme is overblown. I mean, going public is one way to raise capital. And I mean, ultimately, when you take a venture investment, you're signing up to try to create value for the investors and yourself. There are only two routes to do that. You either go public or you sell the company. If you want to build an enduring company, going public is kind of how you do it. You're Mark Zuckerberg at Facebook, not Kevin Systrom at Instagram that's now managing a division of Facebook. So we are much more pro going public as a long-term strategy than the market probably is popularly.
Well, just to question that for a second, because it's more than a meme. I mean, companies are staying private and raising huge amounts. We've seen Airbnb is an example. You sit on that board. Uber is another. These are unprecedented lengths of time and amounts of money to be raised. Do you think that that's going to change over the course of the next year?
Well, the biggest thing that's changed is there now is the ability to raise late-stage capital in enormous quantity. 4 or 5 years ago, there weren't $200, $500 million, billion-dollar rounds because Silicon Valley has never had the facility to write checks that large. So new pools of capital have come into the market, be they mutual funds, hedge funds, sovereign wealth funds, wealthy individuals, and are writing checks that basically allow companies to stay private for much longer. And companies are availing themselves of that option because that capital has been at prices that are attractive to the companies. Very little dilution, lots of capital. You get a lot more time to build your company.
So you've sat on either side of this fence, and you've got some war stories, I know, of what it's like going through the IPO process. Yeah. I mean, give us some examples of what you went through.
Well, it turns out the first financing I ever did was taking OpenTable public in 2009. And for those of you who remember the market in 2009, it was just dismal. I mean, the tech press was saying the window's closed, there'll never be IPOs again. And so we went out into that market, and I mean, it was a fascinating experience. It turns out the tech window, the investors were very happy to invest in a high-quality company, even in a very down market. They actually were looking forward to anything new, because being an investor in 2009 had been a year or two of just utter hell. So, giving them something new and a product that they use, because every investor on the planet, every investor in the US uses OpenTable, it got a great reception. So.
But it helps that OpenTable made and makes money. And the worry about the company staying private for longer is that they're putting off that kind of monetization issue, which is, companies are there to make profits for their shareholders. And do you get the sense that the entrepreneurs who are staying private for longer are consciously hiding from transparency in that way, which would possibly be a benefit for them going forward?
Yeah, I mean, I think being public helps you build discipline at a company that is really useful for the company in the long term. Ultimately, value creation, the value of a company is supposed to be reflected of the value of its future cash flows, which implies that if you want a positive valuation, you should have profits at some point in a company's life. I think this market allows companies not to build that discipline for longer, and allows them to try to stay in hyper-growth phase for a much longer time. I mean, the companies that are raising these monies typically are spending these monies, and they're typically spending it trying to grow. And so, we like the discipline of that process. Also, the other thing about the public markets is they will be, they'll be open in some level, whereas the private funding has come and gone a couple times in my relatively short career in Silicon Valley.
And sometimes the coming in, they're institutional funds, they're not traditional tech investors. You guys at Andreessen, you invest usually from a very early stage, and you think very long term. The people that are coming in, they expect returns. So do you actually think that it's a net benefit when you've got these types of investors who are knocking on the door saying, would like you to return some cash and double it and triple it and quadruple it?
Yeah, I mean, venture's probably a more patient type of capital than a lot of the later stage money they're used to. That said, a lot of these guys are fantastic investors. One of our co-investors in Pinterest is Will Danoff at Fidelity, who's possibly one of the legendary investors of our era. You know, phenomenal investor. He has a shorter time frame than the typical investor does. So, you know, every different pool of capital has its trade-offs, and taking some of this later stage money means that they're going to want an IPO or a M&A transaction at some point in the not too distant future.
Okay. Well, you arrive with a TAM that we're all jealous of, not least because you live in California, you're out there, and we are watching what's happening in Silicon Valley very closely, and there's a slight worry at the moment because we're seeing this issue of tech valuations coming down to earth in some ways. So some of these big companies that have raised a lot of money at very high valuations, they gave away preferential terms to these late-stage investors, and that would be all fine if they could grow into their valuation. It doesn't appear like some of them are going to be able to achieve that. So do you think that the bubble, and I said this on the stage yesterday, might not be bursting, but is it deflating at the moment?
You know, it's actually, we believe we're at a time where some of the iconic companies of our generation will be built. And that's largely because of the shift from the PC ecosystem to the mobile ecosystem is such a massive platform change that it's created a lot of opportunity for new companies. And so we're incredibly bullish on the potential for new company creation and value creation overall. Unicorns will end up venture investment. I mean, it's known as risk capital for a reason.
How many? Give us an estimate.
Okay, yeah, I love that. 16. No, it's and you have no idea who they are because the startup world zigs and zags and comes and goes. You know, Facebook had near-death experiences and now is, you know, one of the most valuable companies in the world. So there will be, you know, it won't be uniform. Everything's rosy and wonderful. It's clear. Loop into the late-stage private tech multiples, which makes sense because if you invest in a late-stage private company, if you think the end game is taking it public in 2 years, you have to pay attention to those multiples. So, you know, the glass is half full, the glass is half empty. They're all not going to make it. Some are going to make it spectacularly well.
But do you think this is a correction that we needed? It's something that valuations spiral to such a degree that actually it's a healthy correction in the end.
As an investor in tech companies, we'd like it to be completely unhealthy for as long as possible. I mean, that's, but no, I mean, I do think as you watch cycles in Silicon Valley and in tech investing, yeah, it is cyclical. It comes and goes. What's important is that we help our entrepreneurs understand that cycles are possible and to manage, and we urge them to manage their businesses in ways that contemplate that. A lot of the entrepreneurs of today have only raised capital in an environment where capital's been very easy to raise and in massive quantities. And that's not always the case. I mean, that has come and gone. So we urge the entrepreneurs to try to, as much as possible, control your destiny. Don't don't live, month to month, mouth to mouth, hoping you can raise that next round at yet a higher valuation. The sooner you control your destiny by generating profits and self-funding, the sooner you take a massive risk factor out of the equation.
I think that's important. You're saying try and resist the temptation to get into the unicorn club. It might sound mythical and fantastic, but actually there's a big downside here, and that's what you're advising entrepreneurs.
I mean, we're proud investors of a number of unicorns. That said, an entrepreneur should be very thoughtful about not pushing valuation as hard as they possibly can, because typically they have to raise the next round. And if you take a early stage business and put too high of a price tag on it, the next time you come to raise money, you have to, ideally, you are topping the round you raise. That's kind of an orderly way to grow your business. And if you chase valuation too hard, that next step can get extremely difficult. So it's not, don't take enormous dilution, but don't reach for the last penny so that you can be a member of a club. I mean, think long term.
Okay, that's enough for my skeptical questions here. Well, taking a positive view, what's exciting you at the moment? I know that things like fintech and online marketplaces are something that you've invested in and are excited by. What sorts of things that are probably investors in the room right now would you suggest that people need to take a close look at? I'm sure you're not going to name the companies that you're...
I mean, I just keep coming back to marketplaces. I've been privileged to work in a bunch of them. eBay was a marketplace, OpenTable's a marketplace, and I listened to Nate Blecharczyk at Airbnb present this morning. Wonderful marketplace business, capital efficient, grows like crazy, incredibly defensible with network effects, barriers of entry. So we're huge on that. We're also very intrigued in fintech. I mean, you mentioned that. Our newest general partner is a gentleman named Alex Rampell, who founded a company called TrialPay that recently sold to Visa, which meant he's now available. And he knows. I managed PayPal for a few years. He knows more fintech. He's forgotten more fintech than I've ever known. So it's great to have a partner like that aboard.
What kind of fintech are we talking about? It seems to me a lot of it is payments, so just to try and get one little piece of the payments chain and get that piece for yourself.
Yeah, I mean,
is there something more?
I think you're essentially seeing is the unbundling of the banking business. We're investors in TransferWise, a local company that's enabling cross-border wire transfer. It's a terrible experience from the conventional banking business. They're building a large business on a very thin product line. And I think you're just seeing thin bank product lines being ripped out of banks and funded. And one of the most unique attributes of these fintech companies is a lot of the angel backing are the traditional banking personnel. James Robinson III and IV invest in fintech companies. Vikram Pandit, former CEO of Citigroup, is a prolific investor in fintech companies. When the traditional ecosystem is betting on the insurgents, these guys understand the ecosystem and they're betting that the insurgents at the wall are going to be successful. That creates an interesting dynamic.
What do you think of the narrative written by people like me that fintech, there's an advantage if you're a fintech entrepreneur in Europe? London has a well-established financial center. Frankfurt, we in Europe do have some financial services expertise, and we can be a dominant player in that. Do you actually think Silicon Valley are going to still do this better than others?
No, I actually think it's absolutely true. I know London in particular has proudly announced we want innovation in the financial markets. We are going to be supportive of digital innovation in the financial markets. In the U.S., that's not always the case. The regulatory apparatus can create obstacles to a lot of the form of risk-taking in banking. So I think London and the UK government, London, I'm less fluent on the German approach, is doing it right. It's like, please bring it on. And there's an element, we call it regulatory arbitrage, where certain jurisdictions are going to say, we don't like, we're concerned about this business. The U.S. is the Federal Aviation Administration in the U.S. has said for over a year, we're going to put out our drone rules at some point in the future. Right. So if you're a drone company, you're confronted with an uncertain future. There are other geographies that said, bring it on. We'll tell you exactly what it is, how it works, bring in the drones. And so I think that aggressive and willingly disruptive regulatory posture is a great posture to have if you want to create jobs in new companies.
That's a strangely positive view of regulation in Europe. I mean, in one thing, drones, but
you should check out some of the U.S. regulation. Yeah, the response to the banking crisis has created enormous fintech hurdles all over the place. London responded differently.
And as a final question, because we're running out of time, do you think the banks they come to me and they say, look, we're trying to respond. We set up venture funds ourselves. We try and invest in these groups. We try and buy these groups. We try and adapt. Are they actually adapting to what's coming?
I mean, you're in an odd place. Technology M&A in the United States should be at an all-time high. I mean, just because you've got a number of cycles of disruption going on, where mobile's displacing PCs, cloud's displacing enterprise. the incumbents are under siege, yet they're not really acquiring. So we think it's some combination of high valuations make those potential acquisitions highly dilutive. And there's an activist shareholder thing going on in the U.S. that is chilling the boardrooms of corporate incumbents. A couple of my friends have fought them. John Donahoe at eBay spent a year or two trying to fight off Carl Icahn. That doesn't facilitate risk taking. Right. I mean, it actually hinders it. So, I mean, they should be adopting this like crazy. That's not the reality at this point, which creates opportunity for startups, which we love.
Well, I can see the time's up sign has come up, so thanks very much, Jeff.
Thanks very much. Appreciate it. Thank you.
Cheers very much.